I think it's probably another 15,
All
10.
right. Actually, I'm getting text to say we are being seen in the
Oh, good.
US, so I think we may as well get started.
Okay. Right. Hi, everyone. I'm delighted you could join us for our update on Europe for US managers. My name is Samantha Taylor, and I am IFI Global's research manager. So this session is going to be broken down into four different segments. The first is, a presentation by our CEO, Simon Osborne. He's going to give a short presentation on the economic outlook in Europe and its relevance for US managers. He will then touch upon the opportunities we see for managers in Europe, as well as investors' strategy preferences. We will then move on to our guest panelists, the first of which is Dan Strackman, who is the Managing Director of ANC Advisors and is based out in Miami. He will talk to Simon about the considerable amount of experience he has had with US managers who have diversified overseas. We will then move on to Timothy Fuchs, the founder of Funds Avenue, which is a third-party AIFM and Manco provider based out in Luxembourg. He will discuss his experiences with managers expanding into Europe and the advice he can give them. Finally, we are joined by Simon Firth, partner at Arnold and Porter, who will be covering regulatory developments across Europe. I thought it was important to mention that in this format, we don't usually take questions. However, if you have anything pressing that you would like to raise, please use the Q&A button at the bottom of your screen, and we will try and integrate your question into our discussion. So that is all from me. I will now hand you over to Simon, who will start his presentation.
Thank you very much, Samantha, and I'm delighted that you can join us today, especially those of you who are joining us and following us from the US, because I'm very well aware of the fact it is the day before Thanksgiving, and I know many people who would have been watching this recording today are traveling this week, and as we are telling everyone, you can also follow this from next week onwards, both as one of our traditional recordings in this format, but also in our fast-growing podcast library. So you can get the audio version via the podcast as well as the regular recording as well. So welcome to you all. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. We have 3 monthly publications and 1 weekly. One of those monthly publications is called FSI, and that specializes in providing help and advice for US managers expanding overseas. It also focuses on new and emerging asset classes, as well as institutional and family office allocations to all the various different fund strategies. And we have an awful lot to discuss today, and I'm certain we'll have an awful lot to discuss very regularly throughout next year as well. So we're going to be doing these sessions very regularly in future, probably even once a month starting from January. So Samantha, if you don't mind turning over the slides, I'm just going to go now and say a few things by way of introduction. So I'm going to talk for about, probably now less than about 10 minutes probably, before we get into our first outside panelist. I'm going to touch upon Europe's economic outlook and particularly what's relevant about it for investor flows, particularly for US managers. And then I'm going to touch upon opportunities in Europe for US managers, as indeed are at least 2 of our panelists coming up. And I'm going to also talk about investor strategy preferences. And I'm going to leave the last point on the screen to Simon Firth, who's the expert, who's a partner at Arnold Porter Case-Shiller on Europe's regulatory developments. So can you go to the next slide, please, Samantha? Right. I spent an awful lot of time in the States, very approximately, perhaps about a third of the year, and it does often strike me when I'm in the US how when I'm talking to managers, or indeed when I'm talking to US managers from over here as well, how generally speaking, of course, there are many exceptions, but generally speaking, a lot of US managers, even those who are reasonably well familiar with the European market, are not that familiar with this economic outlook in this part of the world. And it's frankly extremely bleak indeed. And I do think if you are a US manager, and there are many, many of them who are expanding or are already operating in some form or another in Europe, you really should know at least something about what's going on economically over here. So the largest economy, as I'm sure everyone is aware, in Europe is Germany. It's been in recession for a little while now. That's not really the problem. The problem is that it's got big long-term problems we won't have time to get into now. Just trust me, they really do. They are in, for the first time since the Federal Republic was founded in the wake of at the end of the Second World War, they've got some really long-term economic problems. And on top of what problems they've already got, they're now confronted with the absolute nightmare, because they're a big exporting nation, with the threat of tariffs from Donald Trump, which would presumably come in early next year. The German Economic Institute has forecast that the tariffs that Trump is proposing will cost Germany 150 billion euros by 2028, and will cut their annual growth by 1.4%. And let me remind you that Germany is already in recession. And there are, we have more time to get into this, definitely parallels with the Smoot-Hawley tariffs that were brought in 1930 that had a dramatic effect upon Germany, and is definitely one of the reasons for the collapse of the Weimar Republic and the rise of Hitler. So this is really serious stuff. I'm not saying that's about to happen in Europe now, but I want to mention that only to say that this is not a little deal, what is going on in Germany or indeed across Europe at the moment. It's got long-term problems. Let's move on to France very quickly. France, to quote a very distinguished economic commentators quoted frequently in the press over here in the UK, called Matthew Lynn. He says, quote, "France is heading for a financial crisis that could bring down the Eurozone." France is the EU's second largest economy. Just today, at the moment, and in the next few weeks, they're trying to get their but very restrictive or austere budget through the National Assembly, which stands a very good chance of not getting through the National Assembly given the political composition of it. And what will happen as a result of all that, again, we don't sadly have time to get into, but again, it's a very serious situation. Moving on to Italy. By the way, Germany, by far the largest EU economy, France the second largest, Italy is the third largest EU economy. Its debt to GDP ratio has been around 140% for some time now. The ECB has done a fantastic job at protecting Italy from the consequences of having such a high debt rate as it does have through its quantitative easing program and various other things it's done over the last few years. But that cannot go on forever. And Italy also, just like France and Germany, and indeed some of the other smaller European countries, is in a real trouble. Overall, the Europe or the EU, I think this is the EU, not the UK, the EU has unfunded pension liabilities. This is over and beyond its current macroeconomic situation, but depending on the country, of between 300 and 500% of GDP. To put it bluntly, and perhaps too dramatically, Europe is basically bust at the moment, and no one seems to have a really good idea of how it can get out of that. But the relevance of that for this discussion today is that Europeans who have the wherewithal, and it is still a very wealthy area, certainly amongst the sort of the wealthier parts of most European, if not all European countries, people will be allocating almost certainly significantly more to third party countries outside the European region, and that is principally obviously going to be to the US, perhaps, fair amount to the Asia Pacific region, perhaps, but certainly I would have principally to the US. So there is a huge opportunity over the next few years for US managers who want to come to Europe. UK at the bottom of this little list here. I won't really spend any time talking about the UK. We have had in the summer here a general election. We now have a left-wing Labour government. And as a result of measures in the budget they introduced approximately a month ago now, we are now also going back in terms of our economic performance. We haven't been doing well globally, but by European standards, we've been doing reasonably well, being the second largest growing economy in the G7 for the last year or so. That's all now ancient history. We're going back into, as I put here, the European Pact in terms of our economic performance, which is very bleak. We're looking at substantially increased debt levels and very low growth levels, unless there is a miracle in terms of growth coming along in the next few years, which is unfortunately staggeringly unlikely. So that's probably enough on the economic outlook for the time being, but I really want to emphasize that it's quite a serious situation over here, but paradoxically, it is good news for those managers from third countries who want to find investors in this part of the world. Can you move on, Samantha? Right, so I just mentioned opportunities for US managers. We have recently developed a relationship with an incredible firm, which is very impressive in terms of its AI technology, called PropTech AM, which is also known in the US, it's just opening up in the US, as AIRaise.com. And as a result of that relationship that we've recently started with them, we're learning a lot more about allocations to various different all the different private fund strategies from the professional stroke institutional investor market. So in the brief time we have, this is all laid out in much more detail in our media, particularly in FSI. And if you want to go into this in more detail, it's all in there. But just take it on trust if you don't mind for now. Particularly in the family office market and the high net worth area, there is a lot of activity, particularly globally, a lot of activity globally, obviously, but particularly from the European region, from that segment of the market that is going into various areas. So what's changing and where is the opportunity there? There's particularly from that part of the market, a trend at the moment to specialist strategies and investment opportunities. It's not always in funds. There's quite a significant growth at the moment in direct investing, particularly into some of the new emerging assets that I put down as the third category here. Emerging assets are really coming on leaps and bounds. What are emerging assets? Principally sustainability, which I'm going to come on and say something about in a second, but also, of course, digital as well. Digital covers a multitude of sins, from tokenization of traditional funds through, of course, to crypto, NFTs, and whatever else. There is obviously significant growth in that too, including, and perhaps not as much as in the US, but it is happening over here as well. There was a study done quite recently, which we've just quoted in one of our publications last month by Synergem, that says that extraordinary figure, 57% of the professional sort of investors they surveyed, which is large institutional stroke in professional investors they surveyed, large sample of about 500, said they are increasing or will be looking to increase next year their allocation in some form or another to digital assets. But I am going to talk about sustainability for a second. But before that, I think the next slide, you can switch over, Samantha. Yes, this is from this data we just published in October's issue of FSI. This is just, I took a little bit out just for this short presentation today, and this is from PropTech AM stroke AIRaise. We're doing this now quarterly with them in that particular publication. We are surveying an extraordinarily large sample. As I said, they have access to data on 66,000 LPs around the world on where they think they're going to, these LPs, where they think they're going to be increasing their allocations over the next year. So we've only done this once, so we haven't got anything to compare it with yet. So we'll be back in the market beginning of next year for the next sample. So this is what we did earlier in the autumn. There's a gap between those 1, 2, 3, 4, 5, 6 strategies at the top and the 2 at the bottom, deliberately because I wanted to make a point that it's all where the biggest, most noticeable increases that are happening all in very illiquid alternative stroke private fund sectors. That is what LPs are really going for. Venture capital really does stand out, but they're going into other forms of illiquid alternative strategies in significant amounts too. That is where the increases are coming to. I put those 2 at the bottom just to compare. So growth equity and hedge funds, not so much. That doesn't mean to say they haven't got substantial allocations already to hedge funds or into equities. Of course they have, but they're not necessarily looking to put much more into it in comparison to some of those other areas. Lastly, before we bring up to our first panelist, I wanted to touch upon an area that's of particular interest to Samantha. You can switch over, Samantha, to sustainability. We have a monthly sustainable publication called Sustainable Investment Intelligence. And one of the things it does is track allocations from 3 different investor segments: the pension funds, from sovereign wealth funds, and from family offices, in terms of where they're investing in terms of the sustainable sectors. And this is something we published very, very recently. In fact, I think it was even this month, Samantha, wasn't it? The family office data we published most recently. These are very small samples, and it's probably therefore a little bit misleading to put this here. Forestry, for example, there's remarkably little investment by comparison with the opportunity, in my view, in forestry from pension funds and family offices and sovereign wealth funds, but it is increasing. And there you can see that, because this is hot off the press from 2000, comparing the increase from 2023 to 2024 in those 5 major, those are the 5 largest individual sustainable strategies. I wish I had more time to talk about this. I'm realizing I'm already gone over my time already. But the reason 0% renewables, because it's way by far the largest of all the sustainable strategies. It's by a country mile the largest. 90, as we put here, 94% of families are already investing in renewables. So there was really little scope for them to increase their allocations to that area. If you talk to look at pension funds and sovereign wealth funds, it's even higher. It's closer to 100%. But they're also, as we point out in SII, increasing the size of their allocations into those sectors, as well as already being established in those sectors. And I do feel, this is the last point I'll probably leave you with today, is that what's going on with sustainability is very much like the very early days of emerging market investing. It's the same feel, it's the same problems that managers have trying to get into some of these sectors that emerging market investors had at the beginning of the emerging market boom, but it's got an awful long way to go. And certainly when it comes back to opportunities for US managers in Europe, there's a big interest from the family offices and indeed pension funds, and indeed, insofar as we have them, sovereign wealth funds here in Europe, into the sustainable sector. So if you're a special sustainable manager, this is definitely the right time to strike. And I think that's probably enough for me for the moment. Samantha, if you wouldn't mind stopping sharing screen and bringing Dan up. Hopefully he is available, and we will carry on the conversation with him. Whilst he's coming up on the screen, I should just say that as Samantha's already introduced him, there he is. Dan, hi. I can see your picture. Oh, there you are. Great.
Oh, no,
with
you can see
very fancy glasses.
Well, thank you. That's very kind.
Welcome.
I wear them specifically.
Well, welcome to our webinar this afternoon, and thank you for doing this the day before Thanksgiving, which is much appreciated, because I know half the country is on the move today, So thank you very much.
Well,
Dan, I should just add, he's on the boards of many US managers. I think your background before that was on Wall Street. He's written various books of different shapes and sizes on various financial matters, and certainly has seen a lot of US managers expand overseas. Is that a fair summary of how I should introduce you?
yeah, I think that's great. Thanks for inviting me. It's very kind of you to make that introduction. Let me just tell you right now, I'm needing oxygen and new blood based on what you said. It sounds like Europe is collapsing by the day, and you know, the tariffs that you were threatened, that the president has threatened, or president-elect has threatened, is going to put us all into a global recession. So I think we should all jump out of buildings right now and hope for the best. Let me just correct a couple things, Simon, that you said, I think, which is wrong. And I hope you're not offended, but I know you probably won't be. You know, first of all, the tariffs that the president-elect has been threatening, I think perhaps is just going to be a threat. It's to get some of these big manufacturing companies in line and to make them do the right thing by not only our country, but their own country. And I think that, you know, the issues in Europe are deep, deep issues. And I think one of the things that you're seeing a lot of is the leaders in Europe using the threat of tariffs to build the fire on the left so people don't see the fire on the right, so to speak. And I'm not talking about political right and left. I'm saying the fires that are going on. I mean, I was in London, as you know, last week, and the concept of taxing your country back to prosperity is insanity, right? You're going to tax farmers on debt. You know, they're putting in a death tax on farmers. They're putting in a tax on private schools. You know, they're going to do that, and then they're doing this congestion taxing to get into London. I mean, these people are meshuggah. I mean, they don't understand. They don't understand basic economics. That being said, you know, don't blame the president-elect yet. Give him a month. Okay, let's revisit this in 2025, Feb 2025, and let's see if he does all this stuff. But you know,
Okay.
look, the issue here, we know, and let's be honest with each other for once. China is the biggest issue. Mexico is a big issue. Is German products a big issue? I don't think so. That being said, from the guy who owns a BMW, right? So I don't know. I think that let's the bleakness that you're portraying in Europe, while it is pretty bleak, I think there's some light at the end of the tunnel. But I do think the leaders of Europe are lying to their constituents and trying to blame this on the U.S. That being said, we're not talking politics.
I'm not saying that everyone
is
yet blaming what's their problems on the US. That may come next year. Dan, I take your point. It's too early to give Uncle Donald a bad rap yet. We'll worry about that sometime next summer. We'll see what happens. Meantime, I want to ask you some questions about US managers and the experiences you've had with their expansion overseas. Why do you quickly, because already this is my fault, we're already galloping, time is galloping on. Why do US managers, principally in your experience, decide to develop a business in Europe when they could perhaps go and spend more time in other parts of your huge country or Canada and maybe find investors over there? What's the principal reason do you think they do that?
I mean, I think it's a very simple answer. There's money there, right? You have some very large, you know, pension plans, particularly, you know, in the Netherlands and Germany and other places. You have massive pension plans. You have big family offices and private wealth in Switzerland. You have some legacy families in places like Luxembourg and Ireland and the UK. And so I think there's money there. And I believe that there is a belief by managers and investors that the managers who are coming to Europe and the UK are bringing good products, that perhaps not that the good products aren't being available by managers in the UK and mainland Europe, but I think they're looking at these products and saying, you know, there's a uniqueness to them. And I think that's why the managers are coming and the appetite and the investors are eating, you know, investing. There's, you know, if the U.S. managers wouldn't come to Europe, okay, if there wasn't an appetite for it, because U.S. managers,
that's well put. Can I ask you what parts in your experience, and you've got considerable experience of this, you've been doing this for a while, what parts of the European market, either by geography or investor segment, do you think in your experience US managers have the most success in and that you've seen them working in most? And are there managers in particular strategies that are more likely to move to Europe than others that are in other strategies?
So I'm going to hit the second part of that first. Managers that we see having massive success in raising capital in places like Lux, Ireland, and Switzerland are global macro managers, long-short traditional equity managers, and managed futures managers. We're seeing those three segments specifically having significant success, both with, let's call it the high net worth, ultra high net worth market, as well as the pension market, or let's call it institutional investor market. Those three areas are seeing growth. In terms of geographies of where money is coming from, money's obviously coming through Ireland and Lux, but it's coming from places that are more traditional locales. So places like Switzerland, Germany, France, and then obviously the UK is putting money into these types of products as well.
Right. And from your experience, what are the common mistakes that are made if insofar as you've seen US managers coming to this part of the world and not succeeding? Yeah. What are the reasons why, generally speaking, that happens from your experience?
I think it's lack of knowledge, lack of expertise, failure to understand that the rules, the regulations, failure to understand things like the way people do business in those parts of the world. I think that there's an arrogance to the U.S. That causes managers to not be successful. The managers that are successful are the ones who are using what we would call traditional blocking and tackling to raise money, but and expand their presence. And they're doing that by setting up shop in places like Geneva, setting up shops in places like London, and bringing in, and doing it the right way, right? Getting involved with the FCA if you're in London, and getting involved with the regulators in Switzerland. I think that's how they're doing it. And the other thing, that the big mistake that people make from the U.S., and this is perhaps a little arrogance or just lack of knowledge, is that the UK is a different market than Switzerland. Switzerland is a different market than France. France is a different market than Paris. Even though those countries are all connected and you can drive for them, or there's a commonality through the European Union and the Euro. There is not a commonality in the way they live, the way they operate, the way they think, the way they speak. And so I think that's a failure, that there's a belief by managers, because here that's the way it is, right? We're 50 states, and it's sort of not one size fits all, but everyone sort of looks at it as a one size fits all. And you can't do that when you're going to Europe and you're going to the UK.
Do you have any views on some managers we know and speak to? Their view is often, let's try Europe through a bit of reverse solicitation, whether it's exactly as it's described as reverse solicitation. They don't want to spend the money, they don't want to make the effort, because they could be very specialist and not very large, they don't have a lot of resources or time. And so they maybe somehow or another, God knows how, they find an investor, maybe through a conference or through a connection of some shape or size or whatever it is. So they start off doing reverse solicitation, and they normally have a very good lawyer on hand to make sure they're not going to get into trouble by doing that. And some of them stay like that for a long time. And when I say to them, oh, no, everyone says that's not a marketing strategy for Europe. They go, well, it's fine for us. I trust our lawyer. They're doing a good job for us. We haven't got into trouble. But you're saying make the effort, go the extra mile. Obviously, each situation is different. Set up in Europe, which is obviously a very expensive and time-consuming thing to do, and don't go down that sort of reverse solicitation route. Do you have any comments on that?
Yeah, well, first of all, you can't get a little bit pregnant, right? So if you're going to do it, you got to do it right. You got to build out the infrastructure. You got to make the commitment. And frankly, a manager who says, I don't have the resources or the time, energy, and I don't want to put the time, energy, and effort into it, then probably you shouldn't go. I mean, reverse solicitation works, and you can do it as long as you use a good lawyer, like you said, and abide by the regulations. But the reality is you can't build a business that way. You need to build a business by having boots on the ground, building an infrastructure. And, infrastructure doesn't mean a beautiful office in Mayfair or a beautiful office in Geneva. It could mean it could be a Regis or a work share place, place in one of those locales. And then as the business grows, expands and whatnot, expand out your real estate or footprint in that particular country. But you do need to build an infrastructure, and you do need to show people you're serious. That's the reality of the way it works. And I think someone who says, I only want to go reverse solicitation, there's one word to describe them, and that's lazy. And the second word or words is not fully committed. Either you got to get committed to going after this market and build a business in it, or you don't. And going in the reverse solicitation route forever, to me, is just silly.
Okay, last question. I'm afraid, sorry, it's so short, but we'll have you back again and again in the future. As I said earlier, we'll be doing this a lot more next year. I want a market you're very familiar with, which is Cayman. And I know you're on the boards of a number of Cayman funds. And I know a number of, you'll know this as well, if not better than me, the number of those managers will try and use their Cayman funds in Europe. There's the big debate about whether they should actually go and re-domicile funds into the European region, whether it be, as you say, moving in, all going full Monty and moving into Dublin or Luxembourg and becoming onshore in Europe, or whether as the halfway house, they go to, say, the Channel Islands and they go through private placement, particularly if they're going to the Northern European markets, which are generally pretty open to private placement type arrangements. Do you get involved in those discussions with your managers?
Sometimes, but in those types of situations, we usually defer to the lawyers, or both if they're U.S. IMs that have Cayman structures, or they're offshore IMs that have Cayman structures. We're always telling them to look. Let's have a conversation between ourselves, the lawyers, and the marketing people to determine what the best route to go is in order to number one, abide by regulations in particular jurisdictions, but number two, make sure that you're going after markets that are realistically worth going after. Okay.
Well, Dan, sorry it's so short, but delighted to have you there. Thank you for correcting my pessimistic view of Uncle Donald, that he's actually just doing this as a bit of open negotiation, and it will all come good in the end. I look forward to having you back next spring or summer, and we'll see whether that's the case or not. As I said earlier, it's going to be a very interesting year next year.
Fantastic. Thanks, Simon. Appreciate the effort, and
hopefully see you over on your side of the pond before long. Bye-bye. Samantha, if you could bring up Timothy, who is hopefully standing by.
Yeah, 1 second.
Oh, there you are. Great. I can see him coming on up. Hi, Timothy.
It is working. Hi, Simon. Hi, Samantha. Hi, everybody.
Hi.
Welcome to our webinar this afternoon in this unusual format for you. I think the first time we've done this with you. So let me reintroduce you. Timothy Fuchs is the CEO of Funds Avenue, been based in Luxembourg for a long time. We've just been talking about Switzerland to a certain extent, a market I know Timothy knows extremely well. So we'll get into that perhaps in a little bit more detail in a second. We're delighted to have you here. Timothy, let me start off by asking you, what do you see from your perspective based in Luxembourg and knowing the European region, continental Europe in particular, much better than the rest of us? What trends do you see in terms of asset raising across the European region at the moment?
Simon, thank you for allowing me to participate to the panel. I can identify 4 trends together with challenges. The first one, which I see, is, and you mentioned it rightly, is the increased focus on ESG products. I know we've been talking about ESG since a while. It has been Like sometimes we want to have projects ESG compliant. Sometimes we are not looking for that kind of products. But the reality is that nowadays, from what we see in Luxembourg and in Europe from the clients we're managing, is that retail investors, so typically either direct clients or through their private bankers or family offices, they won't be attracted to ESG anymore for the time being, because some of the ESG product have been doing too much greenwashing, and they have been making too many advertising on the ESG category while losing performance compared to traditional asset classes. But in the contrary, you have all the institutional investors, pension funds that have to provide to their investments, to their committees, and to their investors a ESG focus, and they are very much targeting those type of products, but not only in a wording saying that the strategy is ESG focus or compliant, but with a strong target on investing in companies, in strategies that will lead the change for the future. And again, we're talking ESG about, we're too often thinking that ESG is only ecology, but this is much wider than that. And that's the reason why all the institutional investors are actively and increasingly looking for those type of strategy. So that's the first trend that I see. The second trend that I see is if foreign managers want to enter into the European market, they more often than before build partnership with local players. Daniel mentioned it very rightly. Europe is something that looks like big, that is looking like a unity, but which is not a unity as such. It's 27 different countries, and it's not because a manager has been successful in its home country that the strategy is simply duplicable in a other country. And again, Daniel mentioned it very rightly, Europe is not US and US is not Europe. So we see more and more frequently foreign managers building partnerships with local firms in the EU and in Switzerland. I'll come back about that difference whenever we consider Switzerland being in Europe, but I'm sure that Swiss people don't consider themselves rightly in Europe. But building those partnerships with local firms to tap into well-established distribution networks. So that's the second trend. The third trend that we see is growing interest into the alternative space. And we're talking about alternative space. This is not talking about hedge funds. This is talking about private equity, generally speaking, real estate, private debt. And we've seen that during the last years, there have been a lot of restrictions from institutional investors, but also for retail investors because of the regulation to enter into that asset class. But now the mentalities are changing. The regulation is evolving, allowing that asset class to grow a lot. But we'll probably have the possibility to talk about that in more details later. And one challenge that I see as a trend, but which is also a challenge, which I mentioned before, Europe is looking like a unity, but it's not a unity. And when a foreign manager would say, look, my strategy is great. I have a lot of billions of assets under management. I've been successful on my market, and I'm going to simply duplicate it, and I'm going to reach out to the big Europe, because Europe is 700 something, 50 million inhabitants. There is a lot of money. There are still rich countries, rich families with rich entrepreneurs. But the fact to have 27 different countries, 27 different mentalities, somehow 27 different rules. And then in those 27, I'm I'm avoiding, of course, to talk about Switzerland, which is the aside country. I consider that as a trend, but at the same time as a challenge, because you just can't say, I'm going to go to Europe to sell my product or products. You have to establish a strategy that is probably designed specifically for each country, and you need to target those specific countries and potentially adapt the strategies in those countries for the type of investors you're going to target in those specific countries.
Thank you. You've kind of already answered this, so I'm going to quick sub part of that question is, is there any particular strategy or category of investing that you see being more successful in terms of the market, in terms of your clients right now than others, or is it that too simplistic to ask you?
I would say I can identify two type of strategies that are being successful when targeting European investors. Let's consider Europe as a whole. I see well-established liquid funds, typically US managers having a fantastic strategy, having built their track record, having built their assets, and trying to bring that in Europe, because that kind of knowledge or that kind of allocation or that kind of asset class is not existing or is not represented or is not available in a product, and then duplicating it into a UCITS fund to be able to distribute it to retail investors. I see this as a successful way to bring products and new strategies to Europe, targeting retail investors, but there's tariff analysis to be done to make sure that the strategy is not yet existing many times from other managers. The second thing, which is pretty much what I said before, it's all the alternative space, and you mentioned it in your study and in your figures, private equity, venture capital. So generally speaking, private equity assets. Real estate, it's been hard with real estate over the last 2 years because of the interest rates, but the market is changing. Interest rates are getting lower, and the reality is that the real estate market is becoming again little by little attractive. And the most attractive that we see, and there we're facing many demands from managers from all over the world, is everything that is linked to liquid alternatives and typically debt financing. So debt financing, there can be a lot of strategies around debt financing, but if you look at those strategies that offer attractive returns, that offer decorrelated returns compared to traditional markets, that offer possibility to invest in private markets with, again, a decent return and the possibility to have redemptions, that makes a huge difference. And again, because of the regulation, because of our MiFID regulation that is imposed to private investors, allowing liquidity in a strategy is a big game changer for the time being, offering again a completely decorrelated return compared to the traditional stock market.
Thank you. And sadly, as usual with these things, time is galloping on, so I'm going to ask you to answer these. I got 2 more questions for you, and I see there is an question from the audience, so I'm going to tie that into one of my questions very quickly in a couple of bullet points, perhaps. Are there any particular common mistakes people make that you can inform the audience about, particularly Americans coming over here, that would make they should note?
Yeah, I would see 2 main pitfalls that foreign managers could encounter when setting up in Europe. The first one is coming with no assets, and again, thinking that Europe is a unity, and because I've been successful in the US, I'm going to be successful in Europe. That is not the reality, and that doesn't work for the different reasons that Daniel and I explained before. Second one can be, but it's less a reason why people or managers are not successful, but still finding the right providers and the right partners. And when choosing the right, when I say providers, it's of course all the operational and regulatory providers around the product that need to be proactive, that need to understand the strategy, they need to go mile further than the traditional tick the box work that they provide. And as I mentioned before, finding the right provider also to open distribution network, because if you want to target French investors, this is not the same than German, this is not the same than English, and this is not the same than Switzerland. Now, of course, there's a lot of business flowing through Luxembourg and Ireland because these are the two places where foreign managers do structure themselves, but this is not where the investors are. The investors are in the rich countries, and rich countries are probably France, UK, Germany, and of course Switzerland. Switzerland being a rich country as such, but also Switzerland being very attractive for wealth individuals, for families, for institutionals, and Switzerland has been able also to attract the talents to be able to manage their assets. So that's a great market to enter. But again, when we talk about Switzerland, there's of course Geneva, there's of course Zurich, and making business in Zurich or Geneva, and they are only 3 kilometers away from one from the other. This is not the same network. These are not the same interest from potential investors. So even there are a lot of differences. So my advice would be, a move to Europe can be interesting because there is a lot of opportunities, but that has to be a strategic move, which is more than simply an opportunity to collect more money from abroad.
Very quickly, if you don't mind answering this is a difficult thing for you to do in just a minute or two, which is what are the reasons why US managers should consider using the third-party agent when coming to Europe? And there is a question from the audience saying, how many are there in Luxembourg? I don't know whether you can do that in seconds.
Maybe are there, how many what? Sorry,
third-party AFINs. I think they didn't say
a
third
lot.
party, but how many third-party AFINs? And what are the reasons why someone should use it? Can you do that in 1 or 2 minutes only?
Yes. How many managers? Well, there are 300 something AFMs and UCITS Mancos in Luxembourg. Out of them, probably 30 being active, dedicated
30.
to third-party business. But the reality is that part of those 300, there are some that also, aside of their own business, do provide third-party services. So I would say 10% is dedicated on third-party, and the rest may offer.
And in now, 1 second, what's the reason why the manager should use it?
Well, very simply, which is pretty much what each of our clients is saying. Why would you bother with regulation, with operation, with finding the right provider, with having to take care about things that will not add value to your performance, neither to your distribution network? Give that to somebody else. Of course, this will cost you a few basis points, but those, I don't know, 5, 10, 15 basis points are probably well invested money in order for you to concentrate on, first, performance, secondly, managing your distribution network.
Perfect, Timothy. What a good sum up of the reason for using a third-party banker. Thank you very much for participating here this afternoon. It's great to see you, and hopefully see you again before very long. Samantha, if you don't mind putting Timothy back into the audience, and hopefully Simon Firth will be there. Bye-bye.
Right,
whilst
Simon
waiting for Simon, I will quickly again reintroduce him. He's a partner with Arnold Porter, which is, I'm sure most people following this will know, is a major US law firm with an office in London, and doubtless, hello Simon, many other offices around the world as well. sorry to
That's
give you
right.
the last of the 3 slots here today, but I thought we needed your expertise and knowledge on what's happening on the regulatory front in Europe. So if you don't mind, I'll charge straight in with my questions.
Please do so. Good afternoon, everybody.
The first one being, I haven't heard anything about AIFMD2 for a long time. Maybe if you could enlighten us on what's on earth's going on with that.
Yeah, so we obviously have AIFMD, which has been around for a while, which does allow some limited marketing for non-US managers in Europe. AIFMD2 came into force in April, and managers, local member states have until another 2 years to implement the provisions of AIFMD2. So basically it amends the AIFMD to bring in certain other provisions and to add to various regulatory disclosures. I mean, if you're a non-EU AIFM, a US manager, using the national private placement rules, some aspects of AIFMD2 will impact you. The first one is that they're tightening up on the countries that can market, whose funds can be marketed under international standards, but Delaware funds, Cayman funds can be marketed within Europe as long as they're not on any blacklists. There's increased investor transparency and investor reporting, so there are a few more things that are subject to periodic reporting, a few more matters to disclose on Annex 4 reporting, which is the transparency reporting. There is an impact on liquidity risk management. So there is, if you're a non-US manager marketing in Europe, you may get caught by rules requiring various liquidity management tools to be implemented in your fund. And then the main section that's sort of new is a whole section on loan origination funds, which affect EU AIFMs. So if you were a manager who got on one of the platforms that Timotei was describing, and you'd set up a fund on the Supermanco, you've then got the EU passport. So if you're in the loan originating business, there are now some rules that apply to loan origination funds. Then if you're an EU AIFM, if you're on one of those platforms, or you've set up your own AIFM, there are various other rules coming in as well. Again, I mentioned there are rules on delegation and providing information to your regulator about people you delegate to. There are certain rules about depositories, and there are some new ancillary services that an AIFMD can perform. So that all came into place earlier this year. As I say, it's got a 2-year implementation period. So some member states will be jumping onto that quickly, others will take longer. I should say, by the way, there's no AIFMD 3 in prospect, and
Thank God for that.
nor did AIFMD2 do anything revolutionary, like permitting non-EU managers to use the passport under AIFMD, where there is a mechanism for that to be done. It might have been close just before Brexit, but really it's been in cold storage since then.
Right. And moving on from the AIFMD2, there was a lot of excitement a few years ago. It seems to have gone away because it seems to have bedded down. I hope I'm right in saying reasonably successfully. The EU's cross-border distribution directive. There was concern at one point, going back 2 or 3 years ago, that it might kill off reverse solicitation, which I talked to Dan about earlier, and have some impact upon even private placement, I think. But what's happening with that, basically?
Well, so yeah, so the cross-border distribution directive again amends the AIFMD. So generally it applies to pre-marketing. It doesn't make a huge difference to non-EU AIFMs, except there are some member states requiring them to notify. So the basic point is that it doesn't apply to non-EU AIFMs, and highlights that non-EU, ESMA has highlighted that non-EU AIFMs are not allowed to carry out pre-marketing under the cross-border distribution directive. So that can be changed by local rules in particular member states, and some have done that.
Right.
So, for example, in Netherlands, Germany, you can do pre-marketing. You can in UK and Ireland. UK is not in the EU. But then you bump into other issues which you encounter when you're doing a full marketing under national private placement rules. And of course, as I hinted, these pre-marketing rules don't apply in the UK. So Brexit was already on the agenda by the time these rules were being put into place in Europe. And so in the UK, they weren't implemented.
Thank you. Next question is, what should US managers be aware of on the regulatory horizon, if anything, if they are considering coming over here, rather than the stock of stuff that's already on the books? Is there anything, any nasties on the way that they should be thinking about or be aware of?
Yeah, so there's nothing, there's no large topic that's new. So we've had AIFMD2. We haven't so far mentioned sustainable finance regulation.
No, we haven't, no.
So in the UK, there are various rules coming into place under the UK sustainable disclosure requirements. Those generally won't affect non-EU managers coming into well, non-UK managers, because they largely affect UK managers, UK AIFMs, and of UK funds. So you'd have to be a UK AIFM of a UK AIF, which is, there aren't many of those really. There may be in the private equity sphere, but more importantly is the SFDR, which if you're marketing in Europe, it adds another set of disclosures to your documentation. And the SFDR is being reviewed next year. There were because it has, as people will know, different categorizations of fund disclosures. So Article 6, Article 8, and Article 9, Article 9 being the deep green funds. ESMA consulted on this and is minded to go closer to the FCA's position on it, which is more of a labeling regime than actually a disclosure regime. So that'll be something quite important that'll come out next year. There are rules about naming funds in Europe as well related to sustainable finance. So you can't name funds that imply a sustainable finance component unless you can justify that and it relates to the underlying strategy. There are some other things coming in. I mean, if you were based in the UK, there are rules coming in about bundled paying for research if you were an FCA regulated manager, which is allowing a third way for paying for research. So MiFID required unbundling of research and execution. So you had to have a research payment agreement if you wanted the client to pay for it. If you pay for it, you pay for it directly. There's now a method coming in as a third option to sort of go back sort of to bundle brokerage, to enable people to then pay for research in places like the States where unbundling is not recognized. So there's quite a few things coming down the pipe, but not, as I say, nothing that's new that's going to have a significant impact. Most of it is to do with changes and developments to existing legislation.
Well, that's good. Hopefully that I'm going to probably, sadly, because they're already hit the whole hour right this very second, probably have to wrap it up there. But I would say that unless I hope you would agree with this. It sounds like we're relatively plain sailing on the regulatory front going forward for the foreseeable future. Would that be a fair?
Yeah,
summary?
I mean, as I say, yeah, if people have familiarity with the AIFMD, what it requires, you've got the choice of coming in and using national private placement rules, or of setting up over here or over there in the EU. You know, as Timotei said, it may knock a few basis points off, but if you do the full fund platform, you can then access professional investors in the EU using well-known and well-trodden rules, regulations, and you know, market practices.
Well, thank you very much, Simon. Much appreciated. Hopefully, see you somewhere in person during the sort of December Christmas rush season around the place. Thank you very much for joining us today. Much appreciated.
Thank you, Simon.
I'm going to probably have to wrap this up for those of you who are still there.